Greetings from our team at Robert & Jones Wealth Management. This is Jack Jones with our June monthly market update. As it relates to reopening, if this past weekend, which is Memorial Day weekend at the Marriott Marquis downtown next to George R. Brown, was any indication, reopening is well underway. My wife and our two teenage boys spent some time in the, yes, Texas-shaped lazy river in downtown Houston. I think half of Houston joined us there. So again, if that is an indication, the economy is well on its way to reopening post-pandemic. We were also excited to announce, we made this announcement recently, that following July 4th, we'll again be receiving clients in person. Of course, that'll be your option, but we're very much looking forward to that. So where to start? A lot to cover. I'll start with jobs, which on Friday, June 4th, the numbers were 559,000 jobs added for the month of May. That's very good compared to the very disappointing April jobs number, where over 1 million were expected and only 266 were added. Unemployment is at 5.8%, and wage growth picked up over the last 12 months. So inflation is something that we're talking a lot about after having the hottest number at this 4.2% that we've had on overall inflation in 8 years. This chart just indicates that for the last roughly 30 years, inflation has been pretty low volatility. So not a lot of volatility since 1983. That said, part of that is based on how CPI has been constructed. We mentioned in our May monthly market update that instead of housing prices, they look at a statistic called owner's equivalent rent that measures the housing component of CPI. They also made some other changes to the CPI calculation in the late 90s. So just something to watch. We're carefully watching inflation. It will be very important to see if the Fed talks about inflation in their mid-June meeting, something that we're paying very close attention to. The things that you obviously know are going up: car and truck rental, gas, other things. Some things are also going down. Overall, though, prices are up. So rates have moved up. So we've gone from 1 to 1.7% on the 10-year the first 5 months of the year. So that's negative for bonds. What's interesting is if we look at the top 10 worst starts of the year for bonds, this is the fourth. What's interesting about these top 10 is that for the next 7 months, they're all up. So just because we've started negatively for bonds or interest rates being up and bond prices being down doesn't mean that's what happens the rest of the year. We've also had the third best start in terms of relative outperformance value versus growth. And what this tends to mean over the next 7 months is that that outperformance continues, albeit at a lower pace. Equity ownership in terms of overall stock and bond mutual funds and ETFs sit at 74%, up from 68% in March of 2020, but well off peaks that we saw of 81% before the financial crisis and 83% before the dot-com bubble kind of fully burst. What this shows is kind of what happens the next 3 years, depending on what the current equity weight is. And if you see it less than 70 versus 70 to 76 versus over 76, this is where we sit today. So the average return, if we're between this ownership weight and equity assets for the next 3 years, is 11.3%. One of the things we'll close on that's still a hopeful sign is the incredible amount of cash that's still sitting on the sidelines, being paid almost nothing in cash. Now, it is down from its peak at 4.8 trillion to now being 4.5, but it's still a very large number. There's a lot of risk in the market today, and kind of nothing is cheap. Everything is pretty expensive. But this is one of the things that is positive, that either this is pent up spending that will be spent as the market and economy continues to reopen, and or it's money that will be deployed in a place where the risk return characteristics are more favorable. So that's a brief summary of what went on in the month of May and what to look for in the month of June. Again, for those clients that are able, we're very much looking forward to seeing you in person again following July 4th. If we can help you out with anything at all, If you have any questions about anything covered today, please reach out to us and let us know. Thank you for the trust and confidence that you placed in us. We look very much forward to seeing you, hopefully in person, in the very near future. Until then, stay well and take care.